There's this belief among investors that you're either invested in renewable energy or you're invested in the big bad oil companies. Well, the truth is that you can actually invest in both, and that's what we've done. Here you can see a market cap comparison of Exxon versus NextEra Energy. And in 2020, NextEra actually became the largest energy company in the world and also the largest renewable energy company in the world. Well, today that's changed. So Exxon now has a market cap of $452 billion, and they're almost 3 times the size of NextEra Energy. What happened? Well, here's a price chart for Exxon, and you can see that sharp dip right in the middle of the chart. That represents the market's reaction to the Rona. And in April 2020, the price of oil actually went negative. That's because everybody was concerned that since the world was on lockdown, there wouldn't be any traveling, and the supply of oil went up sharply. Well, since then, shares of Exxon have nearly tripled, and we've actually trimmed our Exxon Mobil position and recovered about a quarter of our cost basis, and that's because the position became a large percentage of our dividend growth portfolio, and when we see positions that are growing too large, we trim them. Rules-based strategies adapt to this sort of unpredictability. So when Exxon was in the doldrums, we actually picked up some shares, and that was a very difficult thing to do because we were quite concerned about their ability to continue increasing their dividend. At that time, they had been increasing it for 37 years. So when you have a rules-based strategy, it works quite well to reduce elements of human emotion that come into play. Now, when it comes to NextEra Energy, we've written about this extensively over the years. We've owned the company for over 7 years. They have had 28 years of dividend increases. So when we added this to our portfolio back in the day, it wasn't a dividend champion. That's a company that's increased dividends for at least 25 years. Now it is. So 28 years, of course, they passed the 25-year mark. This is a utility company, and it comes with that sort of risk profile, but their growth has been remarkable. So there was a comment by one of our subscribers about their growth having lagged, and indeed it has. Here's a chart of revenues. You can see that the lag began in 2020 and then continued in 2021. And here we've simply taken the average quarterly revenues for 2022 and put those in place as guidance for the entire year. And you can see that if that happens, then they'll exceed 2019 and be back on the path for growth. Now, interestingly, this company doesn't provide revenue guidance because that's not the sort of investor profile that they look to attract. So they're looking to appeal to value investors as opposed to growth investors. And when you look at their leadership, this is a great chart in the recent investor deck. By the way, their investor decks are just horrendous. They're very difficult to read. There's too much information, and it becomes quite difficult to digest it all. But this chart shows their leadership in renewables. So somewhere around 33% of wind, 16% of solar, and there's a storage play in there as well. So you could see the next biggest competitor is quite small compared to the size of NextEra Energy's renewables business. Now, when we look at their dividend over time, or let's say their yield, this is very interesting. So that red arrow points to around when we entered our position in NextEra Energy. Actually, it doesn't. That points to 10 years ago based on their decade of growth. So this example is going to show you how yield on cost increases over time. So if you purchased shares where that red arrow is, so about 10 years ago, and that yield at the time was 3.5% because it was, then based on a 10.95% dividend growth over the past decade, on the right-hand side in that table, you can see how your yield would have increased based on your initial capital. So you'd be realizing close to 10% yield on the money that you invested in. Now, for their estimates the next 2 years, 2023 and 2024, they're expecting 10% dividend growth. So that actually means that you'd be coming close to 12% yield on cost after that 2024 raise. So quite remarkable how quickly that adds up. But look at the chart here. You can see this plots their dividend yield over time. Why is that decreasing? That's because the price is going up at a faster rate than the yield is increasing. So that goes to show that investors are approaching this more as a growth stock instead of a value stock. As that yield decreases over time, that means they're more willing to take less of a yield to hold shares. So that's an example of how this firm has grown. Now, when we look at the size, so they're around $160 billion market cap, that sits in our mega bucket, and these are typically positions that will trim because they've gotten quite large. Now, we're going to talk a little bit more about that, but first I wanted to touch on Dividend Safety a bit. So this firm has nearly 2 billion shares outstanding. You can see the number of shares outstanding here is slowly increasing, but very, very small. So look at that legend. The maximum there on that bar chart would be 2%. So more recently, in the past 7 years or so, they haven't been increasing the shares outstanding very long. So when you take shares outstanding and multiply them by the dividend, that gives you the cash needed to pay the dividend. We can calculate that very quickly. We take 1.969 times their latest dividend payment, which is 42.5 cents, and we get $837 million. Well, when we look at their latest financials, that adds up. Here we can see dividends on common stock at 836. It's almost exact. Then you can look at net income and calculate the payout ratio, and that gives you an idea of how much buffer they have so that they can continue increasing the dividend. So last quarter, the payout ratio was 49%. Great, everything's just looking rosy. But when you look at the last 3 quarters, there's a different story because their net income changes. So you can see net income on the same principle as the last chart. Net income is 2625 compared to dividends on common stock 2507. That means their year-to-date payout ratio is somewhere around 96%. So here you can see on this table where we've calculated those similar numbers, taking into account earnings per share, just to check and make sure everything adds up. And then on the right-hand side, we've taken quite a few quarters, looks like 10 or more quarters, added those up, earnings per share and dividends, to calculate the payout ratio. And it looks like historically their payout ratio is in the low to mid 90s. And indeed, that's what we've seen. Now, you have to be very careful when you look at GAAP versus non-GAAP. So this is taken from Charles Schwab, and they show non-GAAP numbers. And of course, the payout ratio looks a lot different. You'll see somebody quoting this 60% when in fact, when you use GAAP numbers, which is what companies report to the SEC, it's a different story. And here you can see our Quantigence methodology has calculated what we call a Q score, and this is based on a number of factors, one being payout ratio, and you see they've actually been penalized. That's because we use GAAP when we calculate our Q scores, so NextEra Energy gets penalized for that very high payout ratio. However, their management team has done a great job of increasing that dividend for 28 years in a row, so we're hoping they can keep that up. Now, our investment in NextEra Energy, when we started putting together our tech portfolio, we evaluated the overlap with our dividend growth portfolio. So we saw that we were holding IBM and NextEra Energy, which could be classified as tech and green tech, respectively. So we decided to include NextEra Energy in our tech portfolio, and then we just dealt with that double counting. So when we look at our assets under management, we want to make sure we don't double count that. Well, just recently we decided, well, maybe the better approach is to allocate 50% of that position to DGI and 50% to the tech portfolio. Well, what we're thinking now that probably makes the most sense is just to erase that entry in our tech portfolio and leave it in our dividend growth investing strategy as it was. Why? Why? Well, that makes for a lot easier accounting. However, it does shift the weighting of all the positions in our tech portfolio because NextEra was quite heavy weighting. So that wouldn't have any effect on our cash and essentially would free up a slot in our portfolio. And from a holistic viewpoint, nothing has changed at all. We still have our exposure to NextEra Energy. It sits in our DGI portfolio, but things become a whole lot easier because now the only reason that we'd sell that firm is if they stop increasing their dividend over time. That's what makes a DGI strategy so effective and very easy to manage. So just to conclude, this is an exceptionally complicated firm. I did the research for this piece, and going through that investor deck and the collateral was very, very difficult. They have somewhere around $56 billion in debt. That's quite a bit. But when we look at this just in the context of our dividend growth portfolio methodology, it's very easy. If they stop increasing dividends, we move out of the position. It's as simple as that. So they have a 28-year track record of increasing dividends and also lots of regulatory headwinds. So in the recent quarterly earnings call, they talk about how the Inflation Reduction Act will benefit them. So things are looking favorable for the company, at least over the next several years. Perhaps that's why they are forecasting that 10% dividend increase for 2023 and 2024. So we believe that perhaps the easiest way forward is to simply switch the allocation from our tech portfolio entirely to the dividend growth investing portfolio. So please put your comments in the comment section. Make sure to subscribe to our channel. Thanks so much for taking the time to watch this presentation today.